let's take a look quickly at this particular spread. We're buying one call, we're selling one call. The difference, and this, I should remind you, this is in the same month, this is in June, and the strike price of the one that we're buying is 75, the one that we're selling is 80. The difference between these two is 5 points. So this is considered a 5-point spread, vertical spread, 5-point vertical spread. The vertical means that it's in the same month and in the same option. Okay, they're both call options. Now, if we were to take the $4.10 and subtract it from the $1.70, because we're selling that one, we're actually receiving a credit of $1.70. We're paying $4.10 for the call option, but we get a credit of $1.70. If we subtract those two, that is what we pay as a debit for this particular spread. So $4.10 minus $1.70 is $2.40. That's what we would pay to put this spread on, this vertical spread. It's also called a bullish vertical spread because we are making a directional play here. We are anticipating that the stock is going to go up. So this 75 call, this 80 call, it's a $5 vertical spread or a bull call spread, and that means that if in fact the stock does go up, we will make money. How much money will we make? Well, we just calculated the difference in these two prices, and it comes to $2.40. The difference between the strike prices is $5. The difference between the $5 strikes and the $2.40 that we purchased this spread for is $2.60. $2.60, if we hold this all the way to the expiration in June, is the maximum amount of money that we'll make on this spread. So you can see that vertical call spreads are, their advantages are that we protect our long call with the sale of another call above the strike price, and that helps to bring in a little bit of premium because we're paying $4.10 for this. We're taking in, we actually get this deposited into our account, the $1.70 into our account, making our net debit here $2.40 for this spread that can be worth $5 at expiration. So our maximum profit is $2.60. So, like I said, we have a spread here that's $2.40. Now, our maximum profit is $2.60. But for us to enter these positions individually, we're paying basically the retail prices. We're collecting the $1.70, which is the bid price. We're paying $4.10, which is the asking price. So the $2.40 for this spread is the retail price of this spread. Let me close this out for a second. Remember the $2.40 it costs to put on this spread. Just remember that for just a second. Instead of entering those orders individually, what we can do is right-click on the option that we want to buy, go over to Buy Vertical, and we can see that it brings up both the option that we want to buy and the option that we want to sell in the same order entry box. And now we can enter this order as a spread, and the mid price is $2.20. The natural price is $2.40. Remember, the $2.40 was the amount that we had entered, the amount of the spread when we clicked on each individual option. So we have the option, though, when we bring these up as a vertical spread and enter this order as a spread rather than individually, we can actually have the opportunity of purchasing this spread for $2.20, which is the mid price between these two set of options, saving us 20 cents on this particular option. Now let's just, for an example, we're only using one contract here, but let's go ahead and confirm and send this and bring up that dialog box. It will cost us $240 if we were paying the retail price, which is the natural price for this, plus a $3 commission, and it will cost us $243 to enter this order. As I mentioned, if we're paying $2.40 or $240 for the spread, the strike price difference between these two options is $5. So our maximum profit is $2.40 minus the $5, which is the difference between these strikes, which is $2.60. And that's exactly how they calculated our maximum profit in the dialog box. Our maximum profit is $2.60 on this spread. Our maximum loss is $2.40, or $240, which is $2.40 per spread, which is the exact amount that we paid for the spread. Okay, so the most you can lose in a vertical spread is exactly what you paid for it. That's the maximum amount of money that you could lose. You can't lose any more than that.